Today I'm going to walk you through how I made my first £100,000, starting from virtually zero in savings to having property, investments, lots of savings and much more. Let's go. There are some people who have a large debt pile, suddenly win the lottery and become millionaires overnight, sailing straight through zero and even past 100k, which is the topic of this video. There will be other people who started from virtually zero, built a business and through sheer perseverance made a lot of money in a short space of time through explosive growth or selling high through a high multiple of their revenue. There are also those people that work in finance, and not all people that work in banks like I used to are in this category, but people like traders, those in the front office, and those types of very niche roles where you can make hundreds of thousands of pounds, if not millions of pounds, in your first few years in the job. And there are also those others that are just tolling day to day, but make hundreds of thousands of pounds, if not more, because they suddenly come into an expected or unexpected inheritance. Despite all of us having heard of people that fit into these categories or stories like these examples are very much still in the minority. The vast majority of people work normal jobs, own small to medium businesses, all trying to work their way up in their careers, in their industries, trying to scale their revenue, trying to get higher paying jobs, trying to increase their income, and their own wealth is growing, just not at the super speed of those examples I've just described. I'm not a trader, not in receipt of a big inheritance, and I've not won the lottery yet. And I've been in business for years, making good money, but I've not seen growth that looks like this. And so in this video, I wanted to show you where my first £100,000 came from. My hope is that it shows you what the first 100k looks like from someone who's living a life that's a bit closer to your reality than someone who is so far away from what you know that their experience isn't really relevant. You can tell me later in the comments if I've achieved what I set out to do. But just before delving in, I want to tell you something. 95% of people who watch my channel are not subscribers. To reach more people and help them in their quest to become better with their money, can I ask that if you're not already a subscriber to hit the subscribe button? It would really help me and the channel out. Thanks for doing that. Now back to the video. My first ever job after university was on a salary of £24,000, which made my take-home pay around £1,400 after taxes. At this point, I didn't need to pay any rent because I was staying with my parents, and I had virtually no other essential expenses either, apart from lunch and my travel to work. I did, however, know that I should be saving for when I got married, as I knew this wouldn't just cost me a few $100. From the ring to the honeymoon and everything in between that I would have to pay for, I knew this was going to set me back quite a lot of money. I saved about £800 a month for that. And bear in mind, this wasn't for a contingency fund. I didn't even know what that was at that point. This was for wedding stuff, an expense I knew was coming. So that was saving for spending. It was saving for something I'd eventually be spending money on. And then I saved pretty much everything else. So roughly £300 a month. Actually, I think I saved about £250 a month to start with, and then increased that to £300. And this was money that I was putting aside for the long term, or whatever that was. As I progressed in my job, got pay rises, overtime, salary bumps between jobs, which I talk about in another video, which I'll link up here somewhere, or here somewhere, one of the two. I gradually increased that £250 to £300 saving per month. And after a few years, it was £500 a month that I was saving, each and every month. And it wasn't like I wasn't going out. I was going out with friends, spending money on the weekends, all that kind of thing. I just wasn't going crazy. And because of that, within 5 to 6 years, I had £20,000 saved up. And I'm not talking about the wedding savings here. That was in a separate pot, but that was for spending, so I don't really count that as savings. And all of this £20,000 was stuck in the high interest savings account, so it was working for me every day. And because of this, I was searching around all the time for the best interest rate I could get on my savings, and switching into the latest best offer constantly so I could make sure my money was doing its best for me, as I wanted that large cash pile to work for me. And so that 20k was built up not only of my month-to-month savings, but also compounding interest that was being added to that balance day on day, month on month, year on year. All I knew about investing at that time was that some people bought gold coins and bars. Okay, so the people I knew mostly bought coins, not actual bars. But all I really knew was that some bought gold and a little bit about shares because my dad and other adults, I don't really know why I did that. I guess because I'm an adult now and it feels a bit weird to call those people adults because... Anyway, moving on. Because my dad and other adults talked about buying shares through their stockbrokers and selling them on for a profit. I knew nothing of funds then. Mutual funds wasn't a term I was familiar with. ETFs weren't a thing, and even index funds, the mutual fund variety, weren't as common. But back then, high interest savings accounts gave anywhere from 5 to 8%, which was really good compared to the long-term returns from the markets. For that period of time, that short period of time, 5 to 6 years, the returns from savings accounts was actually really good. There was a tiny foray I made into in the world of investing a little earlier, but it was tiny. This was the way I lost my first bit of money in the markets, by taking part in a hugely popular IPO back in the day, lastminute.com. I'm pretty sure that was my first foray into any type of investing. I don't remember any kind of investments before then. I didn't need any stockbrokers as it was an IPO that I applied directly for. And then because it was oversubscribed, I received far less shares than I had originally applied for. But even then, I remember being so excited when my first share certificate came through. That's right, all you Gen Zers. No apps, no portfolio numbers on a screen back then, just a piece of paper embossed with the details of your shareholding that I then put into a lever arch folder and tucked away. But that was all I needed, a taste. Years later, I got myself a stockbroker account opened and was then buying and selling shares from £500, £700, £1,000 and then more. Some I lost on, some I made money on. It was all pretty much a flat sum game until I bought some mining stocks and then made a few £1,000s. During all this, I continued to save from my income and I was investing the extra money I was making from the big bumps in my salary as I moved between jobs. Now, of course, with these big bumps in salary, my spending would also go up. I was young, so of course my spending would go up. But critically, my savings and investments would rise too. And I inflated my lifestyle each time, but not beyond my means, and only with money that was left over after I had paid my savings pot. So if I made an extra £1,000 after taxes, then I'd save and invest about £500 of that, and then have £500 left over for spending on other things. Meals out, nights out, holidays, presents, clothes, etc. Debt was a big no-no for me. I had that drummed into me when I was young, and my savings and investment discipline too, to some degree, comes from my parents. But debt was a big no-no. I'd never buy something I couldn't pay for. A few years of all this, including the compound interest from savings and the investment dividends, and I now had £40,000 saved up. A little before the big financial crisis, I bought my first buy-to-let property. My first big investment. You see, I was high on all the learnings I had received from Rich Dad Poor Dad, and I couldn't wait to bring in my first buy-to-let property, my first investment property. It was solely for investment and bought off plan, and a huge proportion of my long-term savings pot went into paying for it. The deposit, the transaction costs, the legals, all of that stuff. I negotiated very well. I've always been great at that, even if I do say so myself. And I got a good deal from the outset. But this took £28,000 of my savings. When the property had been eventually built and the keys had been handed over, I had it rented within 5 weeks after furnishing the property. And this immediately brought in additional positive cash flow each and every month, i.e. it paid for itself every single month and gave me more money on top. And I was always aware that this property investment had taken most of my long-term savings pot, so I knew I had to build it back up again through diligently saving a proportion of my income, like I'd always done. But I also knew that the net equity in this property was part of my net worth. And the property had also slightly increased in value, meaning the net equity that was actually mine, part of my net worth, had actually gone up as well. So my £40,000 net worth had gone down to £12,000 and then a little bit more after the keys were handed over, because I had to pay for a few months of the mortgage and to furnish the property. So £40,000 to £12,000 and then to £8,000. But the equity in the property was there. So actually my net worth was my cash savings plus the equity in my buy-to-let property. So £8,000 in cash and £35,000 in equity, making my net worth at this stage £43,000. But of course my stock investments were also part of my net worth. It took me a while to register that my stock investments were actually part of my overall wealth, because investing in the stock market was still pretty newish to me. I was so used to cash being the only factor that even when I had some smallish investments, I didn't really count it for some reason. Part of this is probably because initially you are really only playing around with stocks. You don't really know what you're doing. You're kind of dabbling, but not really taking it too seriously. You're dipping your toe in, even if you've been doing this, buying and selling, for a few years. But regardless of how you actually feel about it, it is an asset. It is something you should count towards your overall wealth, towards your net worth figure. Once you figure this out and add it back in, your level of seriousness about it increases. So at this point, my stocks were around £7,000. So I had cash savings of £8,000. My net equity in my buy-to-let property was £35,000 plus the £7,000 of stock investments, and that gets me to £50,000. Halfway there. One thing I did was I treated my positive cash flow from my buy-to-let property as additional income, which when combined with my salary from my job just meant a bigger number for my overall income. So more to put into savings and investments from that, and some of course for meeting additional spending needs. I was saving around £6,000 per year at this stage from what I can remember. From my stocks, I lost a few big ticket items during the financial crisis. These shares went to zero, so that put me back a bit, maybe to 52k-ish. I had Northern Rock shares, Bradford and Bingley shares. These multi-thousand-pound investments went to zero, so that 56k became 52k. Alongside that, some of the bank stocks I had at that time didn't go to zero, but they lost 70% of their value. So let's say another £3,000 wiped off their value. The total now stands at £49,000. I'm back under 50k. It was around this time that I started putting some money into investment funds. I got swayed by all the marketing around some selective, actively managed funds. I bought into the Fidelity China Focus Fund, the India Focus Fund, the Global Property Fund, and the Fidelity Global Special Situations Fund. The financial news that was around at that time and all the marketing around these particular funds really spoke to me, and I wanted to be part of their growth stories. So my £49,000 in total assets became £44,000. But hold up, these are investments. These are still assets that I own. So add that value back in. It's still part of my net worth, remember. So £49,000 again. I've just reallocated some of that money. There was a bit of a market recovery over the next couple of years, and I had done some extra buying and selling of shares at a profit over those years too. 3 to 4 years later, with the disciplined saving plan still intact, this is what my asset base looked like. Cash savings of £32,000, the equity in my buy-to-let property was £37,000, the combined worth of my stock and shares, including the funds, was £10,000, totaling £79,000 if my maths is correct, and it bloody better be. Big life milestones had happened. I had gotten married, so now there were 2 incomes coming into the family, and the same techniques were applied to all family income. And this meant more money for savings, more money for investments, and of course at the same time, more money for spending. Having 2 incomes, of course, significantly increased our savings power. But as spending came after savings and investments, it was kind of an afterthought. I'd much rather that than savings and investments being an afterthought after spending. And because of this, for about a year, our savings rate, the amount we were able to save each month, went up. We were probably closer to a total net worth of £85,000 at this stage. We had also bought ourselves a new place to live in. This ate up a large proportion of our combined savings. And we also had to liquidate almost all of our stock investments. Due to a new mortgage being taken on that wasn't generating positive cash flow like a buy-to-let would, as this was our own home of course, the amount we could save and invest dropped. We still had savings mind, but as a lot had gone into our home, this now stood at £20,000. So cash savings of £20,000, the equity in our buy-to-let hadn't moved much, so it was still at £37,000, and virtually zero in any other type of investment, meaning the total now stood at £57,000. But with my jobs during this time, I had built up some employee share scheme stock, which when I heard about how it worked, I jumped straight in. And by this time, I was also in the default pension schemes across 2 different firms. All of this at this point had a combined total value of around £30,000. Meaning our net worth was now around £87,000. I was still always hustling, starting a little side business here and there. A few extra £100 per month started rolling in. Then it went a little down, then a little up. I never really created any systems to turn these into anything scalable, but I did make more to save into these high interest savings accounts, which of course themselves were giving me a boost every month and every year through the interest earned and compounding of course. Continued savings, compounding interest, a buy-to-let property with positive cash flow, and side hustles were always adding to our overall net worth. I did a bit of forex trading, which let me tell you was massive highs and massive lows. It probably lost me a lot more money in the initial few years than I'd care to admit. But then I got more disciplined and comfortable with making small amounts, but critically losing even smaller amounts. If you've ever done any forex trading or spread betting, then you'll know what I mean. So some cash started to come through this way too. I never really added this to savings though, because it was always too volatile to really depend on. We had our first child, which meant we were pretty much back to 1 income again, but we continued to save at the same percentage rate. And it was around this time that I started to invest more strategically. Index funds, learning about fees and how they massively drain your growth, and why what you pay for isn't actually getting you what you think you're getting in return. Sticking to this would have probably taken us over 100k in the next year, maybe 2, but we got there in 4 months. I had a property on my street get put up for auction. I knew my local property market, as I always like to keep my finger on the pulse. And we were also probably only a few years away from our next potential move. So when I saw this hyper-local property right around the corner from us go up for auction for £80,000 less as a guide price than I knew it was worth, I could barely contain my excitement. But at the same time, it was nerve-wracking. Auctions were a new area for me. I knew virtually nothing about them, so the learning curve was steep. And we also didn't quite have the full cash savings available that would be needed if I was successful at auction. I did all my research, managed to claw some cash savings out from other pots, like the holiday pot temporarily, to be able to get to the 10% figure that I would need to have available if I was successful at auction at the price I was willing to pay. And then I got to work trying to find out how I would get a lender to provide the rest of the financing. Auctions work differently to a normal house purchase, and the timing to complete is very tight, which means you need to have everything in place at the outset or you could lose a lot of money. I negotiated a financing arrangement with a private lender, with all the legal wranglings that this required, and then at auction we were one of only 2 bidders on the property. The bidding started under the guide price, and we won the property at the guide price. The other bidder clearly didn't want to spend a penny over. As soon as we got the keys, it took 10 seconds for us to walk over to the property, and we were treated to an almost identical version of our home. Some rubbish disposal, fixing and maintenance work, and some IKEA home furnishings later, and we put the property on the market for the full market price. The private financing I mentioned earlier was costing a small fortune, so we wanted a quick sale, and we knew we were willing to knock off £10,000 off that price if a buyer could show us that they could complete quickly. We had a number of bids at the asking price, but only one that could complete as a cash sale. We negotiated a £5,000 discount and completed with a tidy profit of £40,000 after all taxes and costs. This took us over the £100,000 number and put us well on the way to the next 100k. It was a good thing too, because I was better at investing by this point. So we had a good amount to supercharge our investing efforts from this one deal. So this was our journey. And as I said at the beginning, I shared this in the hope that it shows you what the first 100k looks like for someone who lives closer to your reality than the reality of the super rich. And I also want this to inspire you to chart your own path towards your first 100k. Diligent saving, investing, and turning the way you spend and pay bills upside down is what made this journey possible for me. I've described this in another relatable way in this video over here, which is one I recommend you watch next to really embed this in your mind.